One thing they did, though, Aastha, is that they decided to actually loosen restrictions on bank lendings for acquisitions and also increasing the amount of capital banks can actually devote towards supporting IPOs. In some ways, it's a loosening or liberalizing at least of funds that can go into the market systems and into the markets in India. In some ways, is this another way where the RBI perhaps is choosing to support the economy, not through cutting rates specifically, but actually just making sure that the rules are looser at least for banks to provide more capital either through supporting acquisitions or through supporting market activity right now?
Absolutely. So, JP, in the way that we are looking at things, I think rate action yesterday was the sidekick. It were these 22 measures that the RBI governor announced closer towards concluding the policy that tried to cover a variety of aspects. And I would like to take this point and explain that we may not want to call them looser. We may want to call them more pragmatic because they are better curated to the capital structure needs of the day. So we are acclimatized and we are very familiar with large exposure framework, with the overlaps between banks and NBFCs, with banks not being allowed to do M&A financing. And we thought those were the best practices to do at a particular point in time. With capital structures now evolving, financial markets becoming more developed and more mature, data becoming available on all sorts of things, I think the RBI made a very pragmatic approach in trying to ease out some of these measures which will support doing business in India, which will support bank credit in India, NBFC credit in India. And some of these policies were in a way restrictive and were not exactly suited to the current funding demands of the economy, especially from large corporates or for banks which had NBFCs that had overlapping lines of businesses. So I think ease of doing business, improving the flow of credit, of course, giving some support to exporters and importers in this dire time, nationalization of rupee, and policies on how to strengthen the financial institution structure in general were at the heart of these 22 measures. So while we were not exactly kicked about RBI not cutting rates yesterday, I think these 22 measures made it look like a mini budget for India, so to say.
So pragmatic, not looser. I stand corrected there. When you look at the measures right now to support the economy through that, and you combine that with the GST cuts, actually, in some ways, is this a way of betting on India's internal ability to sustain growth amidst all of these externalities right now? Basically a bet on the Indian consumer and also a bet on Indian business optimism to sort of insulate or to sort of guide the economy through some of these rougher patches that's really hitting most of the world at varying degrees.
So India is a domestic-oriented economy. 60% of our GDP comes from private demand. External demand is an important factor for India, but it is significantly lower in its contribution as far as our gross domestic product is concerned. At a time where many countries in the world are feeling hostage to geo-economic fragmentation and the tough trade and tariff policies, India is, of course, at a relatively more disadvantageous position given the kind of tariffs that we are witnessing. In that light, coming out with policies which strengthen domestic demand, which strengthen the capabilities to lend to the corporate sector so that we can reignite private investment, are absolutely the right thing to do. So our strength lies in domestic consumption and private investment. And I think the kind of measures that you have seen coming from both the government and the Reserve Bank of India in terms of providing consumption support through GST rate rationalization and providing investment support by allowing banks with healthy balance sheets to start lending for many of the activities that they were previously wary of, are the right messages to be given to ensure that growth story stays intact. And I would like to draw your attention to the upward revision of the growth forecast that the Reserve Bank of India did yesterday. They now look at growth coming in at 6.8% in financial year 26, up from 6.5% last year. Although it has peaked with the last print coming in at 7.8, but I think we will be surprised to see how few our global economies right now clocking in a 6.8% growth rate.